Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So today I'd like to think out of the box a little bit. I'd like to talk about how to design an options trade, a market neutral positive theta options trade, but design it in a way that will be consistent with your market opinion about volatility. And today's discussion came about as a result of a meeting of our options community, which took place yesterday. It's called the Options Tribe, and we meet every Tuesday at 4:30 p.m. in a free webinar. And during that meeting, our presenter, Paul Forcione, talked about a trade which sort of looks like an iron butterfly, but it actually is not, and it is protective against volatility going up. So it's sort of an iron butterfly that deals with volatility better than an iron butterfly itself does. And so it's a very good example of how you can manipulate options so that your market opinion about volatility, about direction, or whatever can be incorporated into your strategies so that you're not stuck flat-footed in a situation that was obvious. Instead, you have some tools at your disposal which help you to be a better options trader and help you to adapt to the environment. So in our current market environment, we are in it's August, it's a slow month on the market. The market has rallied and it's channeling, and these are typically low volatility times in the options market and in the stock market in general. As a result of that, we who sell options time premium short, we do not get paid as much for those short premium positions as we would in a more volatile market. So it makes it a little bit more challenging for us to make money. It particularly becomes challenging when we go from a low volatility environment to a high volatility environment. When you're in a very low volatility environment, you are particularly exposed to the possibility of getting hurt as a result of volatility picking up. Well, there are ways of dealing with this, and today I want to give you simply an example of that, and it came up yesterday during our Options Tribe meeting. So I'd like to bring it up to just kind of emphasize the importance of this concept. As you can see, we're in this low volatility environment. It's the market on the date we'll be talking about today, which is August of 2016, was at one of the low points of volatility actually for quite a long time. It's right around its normal floor, which means we're particularly exposed to an increase in volatility. And so let's suppose that on August 17th, when the SPX, the S&P 500 index, was selling at 2180 area, suppose we wanted to do an iron butterfly that day with 35-point wings. So we would sell short the 2180 call, we would sell short the 2180 put, and that would be the short straddle, which is at the core of an iron butterfly trade. Now that trade alone, without the wings, has about $5,000 of negative vega. And in the English language, what that means is if market volatility picks up and options volatility picks up, then for each point of volatility, the way that it is measured, you would lose $5,000 on this straddle. Well, that's not something anyone wants to do, and so we would normally put wings on the trade to cut that exposure to volatility substantially, and also to cut the unlimited exposure of the upside call, as well as the disastrously bad exposure of the uncovered short put. So that would be done by buying wings, in this example, 35 points away. That cuts the delta to, that cuts the vega, the exposure to implied volatility, from about 5,000 to a little bit over negative 800. So an increase in volatility would hurt the butterfly much less than it would hurt the straddle, but it still hurts. It's negative $800 for each point of implied volatility that the options increase. So suppose you said to yourself, wow, we're at a very low time here in the market. We don't like the volatility climate. However, we're willing to be exposed to a situation where we have very little exposure to a drop in volatility and very little, or excuse me, to an increase in volatility. And of course, in doing so, you're, if there is a further drop in volatility, you're sacrificing that. But since volatility is so low, one wonders how much lower can it get. But we all know that it can get much higher. So the betting money is, it's more likely to gain 5 or 6 volatility points as it is to lose 5 or 6 volatility points. So it might be a good idea to not be in such negative vega positions. So how would you do this? And it's really quite simple, as Paul Forcione pointed out last night in our Options Tribe meeting, and that is you just move your wings back into a later options chain. In this example, in the next week's options chain after the monthly expiration. And what that does is, by simply moving, keeping the strikes the same, but moving the long wings from the current month to the next available options chain, look what happens to your vega. Your vega, or your exposure to options volatility, basically goes to 0, negative 13, close enough to 0 for government work. So that is how you can essentially solve your concern. And the trade is a very, very similar trade in terms of its risks and rewards, but the vega, the volatility exposure, is quite a bit less. Real simple solution that might not have been obvious if an options pro like Paul had not come up with this idea for our webinar yesterday. So rather than feeling trapped by a protocol that you've set up for yourself, I'm going to put on a 35-point butterfly every month in the SPX. You might be the kind of a trader that thinks like that and is very consistent like that. And that consistency actually is a very good thing. But you're not trapped by your protocols. If you're convinced that you are going into an environment that's going to be weak for the strategy that you have, you don't have to stick with that strategy. You can tweak it and modify it in such a way that's more consistent with whatever is concerning you. There's always going to be a downside to it. If market volatility drops further, that trade will benefit less than the iron butterfly would have. But if the likelihood is we will see a spike in volatility more likely to occur than if we were to see a drop-off in volatility, then then this trade probably makes a little bit more sense for you. So I call this the difference between being a rule follower and being an options trader. A rule follower would just slap the butterfly on every month and not think about the environment. An options trader thinks about his environment and uses the tools at his disposal to adapt to that environment. So think about being an options trader, somebody who's thinking constantly about ways to improve their trading game by using all the tools available to you, and long term that will help you to be more successful. Thanks very much, and we'll see you next week.